ATWAP.
Aye.
ATWAP. Good afternoon, ladies and gentlemen. I'm very happy to be in your midst this afternoon. When I think it's the secretary, when he reached out to me last week that I should help him get someone to handle this course, I asked him, what am I doing? Because the best way to make sure that all of us is safe in Nigeria, we are all safe, drinking water, is to make sure that we account for whatever we are doing properly. If we don't account for the water properly and we get it to the market, people will not know what they are drinking. And I'm very happy to be in your list. I'm happy to see that you are a very organized set of people. So I pray that in the business you are doing, that God Almighty will grant you all successes and profits. Now, we go straight to business because our time is fast spent. We want to look at accounting for small and medium businesses. The content, we are going to look basically into 4 aspects. The first aspect are the essentials of bookkeeping. The second one, the principles of costing. The third one, basic balance sheet and income statement format. And the last but not the least, determination of profit. Now, the first question we will ask ourselves is, why do people go into business? And the reason we are asking this question is because you see a lot of people, they go out, they make money, they come back and they are happy. But the money you have made, do you know whether it is profit or you just made money? So the reasons why people go into business, one is for financial independence. You want to make money to take care of yourself and feed your family. You want to be able to start a business so that you can create another stream of income to complement your monthly income from work. On the other hand, as a full-time entrepreneur, you can run multiple ventures to create more income streams for yourself. Now, the second reason is flexibility. You want to be able to enjoy the freedom of working whenever you want. You want to go on vacation when you like. The other one is pursuing passions. Maybe you have a passion for something and you decide that, let me turn this thing I have passion for into a business. The next is creating change. You have identified certain things, like Dangote discovered we are always having fuel scarcity in Nigeria, and he decided to go and build a refinery so that it will make money and there will not be fuel scarcity again. I pray that will happen. Now, essentials of bookkeeping. Our focus here is on the aspect of financial independence, making money, because the whole essence of the business you are running is because you want to make money. So we will focus more on that and leave all the other things. We all want to make money, and we want whatever money we are making to be sustainable. Sustainable means that something that will continue, and we want it to be consistent. If you are making 10,000, you want to be making 10,000, not 10,000 today, 1,000 tomorrow, 3,000. So you want your money that you are making to be sustainable and consistent. You have invested cash in your business and you expect the business to grow, you expect the business to sustain itself, and you also expect that business to give back to branches and other businesses on the long run. You therefore need to keep track of the following items. The cash you invested into the business. You started the business with a certain amount of money. You need to keep track of it. This money I started the business with, where is the money? You need to also keep track of cash you have injected into the business. Probably a family member came and said, I like this business. Let me also boost by adding more money for you. If you are doing this thing and you are making this money, that means if you have more money, you will make more money. Let me invest in your business. Or you go to a cooperative, you take loan from them because you want to expand your business. This is what we call cash injection. It's different from the one you used to start the business. And of course, the third cash is the one generated from the business. You have started producing water. You have sold. Your truck went out in the morning. They came back in the evening and they came back with cash. So you also want to keep track of the money they have brought back. At the same time, you also need to keep track of all these monies we are talking about. How did you spend the money? Both the one that you used to start the business, the one that was injected into the business, and the one you generated from the business. You need to keep track of them. And this is the whole essence of bookkeeping. Bookkeeping, therefore, is the act of recording your daily business transactions in a systematic manner so that it will show your exact state of business at a particular time. Now, take note of the operative word systematic. If you are doing it in a way that is not systematic, it is not bookkeeping. If you just write they got money today, it's not systematic. But you must keep it in such a way that whatever is coming in, you record, whatever is going out, you record in a systematic manner. And we also spoke about a particular time. Accounts are prepared for a particular time. That's why you see so account for the period ended 31st December 2023. For the year ended June 30, 2024. For the month ended 31st January, there must be a period. With the invent of technology these days, you can also do it for the day ended. You can prepare your account on a daily basis, but it must be for a particular period. Now, systematic classification of cash. Cash you invested into your business is called owner's capital. The one you injected, I told you the difference between the one you invested and injected. The one you injected into the business is called working capital. Note that both of them are capital. But the one you invested to start it is your owner's capital, while the one injected is working capital. It could be through a loan, it could be through borrowing, it could be through family investment. While the one generated by the business is called revenue, or some people just call it sales proceeds. Cash you use to buy raw materials, or pay for labor, or pay for other direct factory costs. That one is known as direct cost of sales. And the cash you use to pay for running the business, day-to-day running of the business, is called expenses. Now, all these things are cash, but they have different names because we want to systematically classify them. Other systematic classifications in bookkeeping. Other systematic classifications in bookkeeping include customers that buy from me on credit are my debtors or trade receivables. Customers that sell to me on credit are my creditors or my trade payables. Assets represent everything that belongs to my business. Liabilities represent everyone that is owing my business. So if you have this basic understanding of bookkeeping, you already have a basic understanding of all your business. Now, the next thing we need to understand are some basic accounting principles. We will look at two, because I understand this is not supposed to be a technical accounting class. So we just look at two that are relevant to us. The first one is the entry system. Now you need to determine before you start preparing your book that what kind of entry system do you want to keep for your business. Do you want to do the single entry system, or you want to do the double entry system? Now, the double entry is the one they tell you must have heard about it, that everything that has a debit must have a credit. And that's why they talk about balancing of accounts. If everything that has a debit has a credit, then at any particular point in time, account must balance. That is what is recommended in bookkeeping. But of course, for single entries, you can also use it if you are diligent enough to track your books regularly. Let me just define this. Now, single entry reports all your transactions once, either as an expense or as an income. That means you have one book, page one of the book, every money you spend, you call it expense, you write everything there. You have page, maybe you cut it to the quarter of the book. Every money you spend, okay, the first one, every money you make, sales proceeds, you write it there. You go to the quarter, every money you spend, you write it there. So that at the end of the day, total money I spend minus total money I make, you look at it. It doesn't track the value of your business. That's a disadvantage, because you don't know whether you are making profit or you are making loss. You can't keep track of the people you are owing or those that are owing you if you are doing single entry. But for double entry, it enters every transaction twice as both a debit and a credit. Your business books are balanced when all the debits equal all the credits. Although this looks more complicated, it will prevent bookkeeping error. Because at the end of the day, when you see that you have more debit than credit, that means there's an error somewhere. When you are doing single entry, you will not know when there's an error. Also, since it takes equity, assets, and liability on top of expenses and income into account, it typically gives you a more accurate financial snapshot of your business. So the next thing we talk about is the accounting method. We have spoken about the entry method we want to use. We say there's single entry and there's double entry, and we as accountants we recommend double entry. And the next one now is accounting method. You want to recognize everything you are doing on cash basis. When my sales people carry water out, it is only the one they bring cash that I recognize as sale. The one they sell on credit is not yet sale. Or you want to recognize both the one they have sold on cash and the one they have sold on credit as your sales. So when you recognize only the cash, that is cash basis accounting. But when you recognize both the credit sales and the cash sales, that is the accrual basis. You have accrued for the ones they have sold. And that is what accounting also recommends for you. Because anything you sell, whether the money has come or not, it's already part of your sales. The item has left your warehouse, the item has left your possession, it's already with the other person. They have drank the water or they have sold the water. So they have turned to your debtors. Praise. Okay, we are not in it, so let me say praise the Lord. So, ATWAP, yes, ATWAP. I hope we are all listening. ATWAP. Okay. So generally, accrual basis is recommended, and it is more aligned with the generally accepted accounting principles. Managing transactions is a big part of any daily bookkeeping routine. It includes importing and categorizing transactions properly, reconciling these transactions, and making sure they are recorded according to your entry system and accounting method. Don't treat some transaction using single entry and treat some using double entry. Account no go balance if you do that. Don't treat some on cash basis. It's only the cash I receive that is my sale. But when you go to buy things from people, you recognize the one you have bought on credit. You must be consistent. You must be consistent. So, and the other thing is that you must be diligent in your entries. I'm sure many of us, you know that, especially the way Nigeria is today, if you go out and maybe you have 10,000 in your pocket, by the time you get back home in the evening, you bring it out, you see 1,005. The first thing that will come to your mind, did I lose money? The next thing, did I buy something I can't account for? But at the end of the day, if you settle down, you start calculating transport from Wuse to Gariki, I ate lunch, I bought fuel, I did this, that is remaining 1,000. I must have spent it myself. So it's the same thing with accounting. If you don't quickly document what you have spent, you will lose track on it. So you must, as a matter of urgency, keep daily records of every money that you spend in your business. Who should manage small business bookkeeping tasks? There are three main ways to tackle your bookkeeping for your small businesses. The first one is do your own small business bookkeeping. You want to keep your records by yourself. That is what almost everybody does these days. And accounting software makes it very easy these days. But I don't know how many of us are using accounting software. But I want to recommend for us that if you want to keep your records by yourself, it's better you use accounting software. Don't try to use manual. Don't use manual. Manual entry, you use calculator, you add, you subtract. At the end of the day, it will not work. But at least if you have a software, you can, everything you sell, just be typing it. I sell 20 bags, I sell 10 bags, I sell 15. At the end of the day or end of the month, it will give you all your records. The software will automatically do the debit and credit for you. The software will automatically give you your profit. It will let you know whether your business is profitable or not. That is, however, it can be difficult to catch up if you fall behind on reconciling transactions or tracking unpaid invoice. Unpaid invoice is very critical when people buy on credit and they have not paid. So if you don't keep track of it, it's going to be difficult at the end of the day. They will mangle it. Even in my office, they come, Oga, there is no fuel, you give them. Oga, there is no transport, you give them. At the end of the day, how much money did I give you? It's difficult to keep track of it. But there must be records, something we call vouchers, so that everybody that wants to take money, they sign voucher, you approve it. So that even if you are not recording it yet, you keep it in a file. Then at the end of the week or end of the month, for every money that you have spent, you can now be opening it and adding it up. So that is when you decide to keep your accounts by yourself. The other one is that you can outsource bookkeeping service. You can look for an accountant like my young self and say, okay, you know what, let's have an MOU. Every month you come here, you look at my records, and I will also tell you, okay, this is my terms and conditions. Every money you spend, this is what you should do. Every money you receive, this is what you should do. And at the end of the month, this outsourced accountant will come. It will be cheaper than hiring an accountant. But at the end of the day, the job gets done. Now, the third option is for you to hire an in-house bookkeeper. So you look for somebody who has accounting qualifications. You hire such a person, and the person will take care of your accounting bookkeeping for you. However, make sure that if you want to hire somebody, you are careful in the process of recruitment. Bringing a part-time or full-time professional into your business gives you access to gives them access to your it gives you access to their own expertise, but it also gives them access to your own business strategies. So you have to be careful there. So you need to still be fully involved in whatever the person is doing. Don't just say because I have accountant will do everything. You must understand, why did you do it this way? Why did you do it this way? So that you too will have a good understanding. It's also important to know that your bookkeeper won't be the only person working on your business finances. You will need to understand what task your bookkeeper is responsible for and the one is not responsible for. Your bookkeeper should not sign checks. Your bookkeeper should not keep cash. His own work should just be to keep records. Essentials of bookkeeping will continue. Why bookkeeping for small businesses is important. Without bookkeeping, it will be difficult to get an accurate picture of your business health. That's business financial health. There are some other reasons why the process is crucial for small businesses. One, you separate business and personal finances. If you don't keep your books properly, you will go and eat amala, and you will put it as your business expense, but that's your personal expense. Somebody will come to visit you, you will give you put it in your business expense, but that is your personal expense. So when you do bookkeeping, it enables you to separate business and personal finances. As the owner of the business, you can decide to place yourself on a salary. After all, I'm the owner of this business. I should be able to buy fuel for my car. I should be able to entertain my customers. I should be able to do basic things from the money of the business. We advise that you put yourself on a salary. At the end of the month, pay yourself a salary so that there's proper accounting. If you are just taking money from the business is being killed gradually. Identifying mistakes early is another reason why it's good for us to keep our records. As I said, if you are doing double entry, at any point in time, you will know when the account is not balanced. If you remember bankers of old days, the reason they used to close late is because accounts never balanced. We thank God for software now. Accounts balance very early. They can close at 5 o'clock. But in those days, if account does not balance, bankers will not go home, because that means there's an error. There's the one they call shortage, there's the one they call overage. When they overpay somebody, it's a shortage. They must find it before they go home. When they underpay somebody, it's an overage. They must find it before they go home. Same thing with your businesses. Don't say because it's your personal business, so you don't want to know when there's an overage or where there's a shortage. Sometimes people come to buy things for you and they overpay you. I'm sure you have noticed that. So that means it's also possible that they underpay you. So you must identify all those things as quickly as possible. The next thing is that it simplifies business finance. It's streamlining. Now, FIRS, they are pursuing everybody. I don't know whether they have reached your side. Have they reached your side? FIRS and FCTIRS. One day, they will get to your side. So if you keep your records properly, when they come, the tax people, those are the FIRS I'm talking about, when they come, it will be easy for you to show them your records, rather than for them to just use rule of the thumb to estimate how much tax they are owing government. Also, I want to advise you, we have spoken about separating business and personal finance. It's key, because if you are putting your personal finance in your company account, the day the tax man comes, every money that goes into your account, they will say it is business income. Now, it also helps you to keep an eye on the financial health of your company. You are making money, they go out with the truck in the morning, they come out with cash in the evening. They come with cash in the morning, they come with water in the morning, they come with cash in the evening. After 6 months, if you started the business with 10 million, how much is the value of the business? Is it still 10 million? Is it now worth 11 million? Has it reduced to 6 million? That's why it's important to keep record of your financial health. Then it helps you to organize documents and records. It simplifies the process, such as applying for a loan, as our April secretary said. When POI comes and they say they want to help businesses, they want to assist you to acquire water treating machine, or they want to, like during COVID, government said they were going to give schools there was one money government gave schools because people were sitting at home. If you don't have records, they will not give you. It's those that had records they were able to give that time, apart from those that manipulated their way. And I don't think anybody is a manipulator here. Principles of costing. We've spoken about essentials of bookkeeping. So the reasons why we need to do bookkeeping. Now, we are narrowing it down to the principles of costing. The reason why your association called us here is basically because of costing and pricing. That many members are not conscious of how to cost their items and how to appropriately price their items. So costing is the way the entrepreneur, that's the owner of the business, calculates or works out how much each individual product costs to produce. If you produce a sachet of water, costing will help you to determine what is the cost of that sachet of water. You can narrow down to that one back. How much is this sachet? But the last time I bought it was 100 naira, but I know in Nigeria today everything is going up and down. So let's assume 100 naira. If one pure water, one sachet, is one. I'm even talking about one. If one, because now now one I know they buy fast, I know if you are talking. But if one, if they sell 3 for 50 naira now, 25 naira for one. If one is 25 naira, then as an accountant, I'm interested in knowing what is the cost of this sachet of water in my hand. So if it costs 21 naira to produce it, definitely I can't buy it below 21 naira. And this is what will now translate to a bag. How many of it will be inside a bag before you now start selling it out to people? So costing is the way you calculate or work out how much each individual product costs to produce or sell. It is important for us to cost our items before pricing, because it helps us to set the appropriate price, a fair price, and a competitive price. There are two major components of cost. There is the direct cost. That direct cost is this one, goes directly to producing this one. There is no way, for instance, that you can finish producing a sachet of water without that nylon that you used to wrap it. I don't know the name you call it technically. What's the name of it? Printed roll. There is no way you can, because that's what packages it. If it enters the bottle, it's no longer sachet water. So it's very important that that printed roll is direct cost. The water itself is direct cost. However, you have some staff that are helping you to work in the factory. Those guys are direct labor. They are the ones packaging it, the one on the sealing machine sealing it, the ones picking it, the one counting it. they are part of the production process. And because they are part of that production process, they are part of the direct cost of producing water. Now we have the indirect cost of fixed cost. Electricity, diesel, these are indirect or fixed cost. You need electricity to produce water. You need diesel when there is no electricity to pump your generator to produce water. There are some other things you need, you know them, I don't know all of them, that you need that are not directly related to water. But if you don't have them in place, water will not be produced. These are the indirect or fixed costs. They represent all business expenses or overhead that must be paid whether or not your products are sold. Indirect costs include items such as rent, electricity, telephone, salary, insurance, and depreciation. Now, we've spoken about cost. What is pricing? I hope we know that there's a difference between cost and price. Cost is what goes into the production, while price is how much you are selling the item. So cost plus margin is what gives you price. You must have a margin, because in my first slide was why do we go into business? And we agreed that we go into business to make money. We are not a charitable organization. We are not just doing water and let us just go and share water. We are doing water because we want to make profit out of it. So the cost of production plus a margin is what will now give us price. Pricing is decided. So pricing is deciding what to charge for your goods or services. Now, some factors affect pricing. How the competition prices their goods. You want to make sure that your price is priced along with competition. Anybody that is doing the same business with you is competition. It does not need to fight with you. But the fact that all of us are seated here now, we are all competitors. But you need to have a uniform price for you to compete favorably. That's why you have come together as a union, as an organization. So how competition prices their goods and services is very important when you want to determine your price. The expectations about sales, how much can I sell, is also necessary. The expenses you need to cover, how much am I going to pay on this, how much am I going to pay on this, because at the end of the day, for you to make profit, not only will you cover your costs, you must also cover your expenses. If you cover the cost alone and you don't cover the expenses, you have eroded the capital invested in the business. The next thing is how much money the owner wants or needs to make. You want to just do it because you want to do it. Let me give you something interesting. All these big people you see that are opening clubs, lounge, or big Cubana and Co. The difference between them and other people selling it by the roadside is the pricing. This one will buy his own, this same bottle of beer or champagne, we will buy it for 2,000 naira and sell for 2,500. While the other person will buy it and build a fine house and say, oh yeah, because we are coming into the fine house, come and pay 10,000 naira for it. And people want to go and sit there and collect AC, they will pay it. While those who want to sit beside mosquito, beside the gutter, they are ready to just pay extra 500 and drink the same thing. So how much the owner wants to make is also important. Of course, we know that capacity is also involved here. Then market tolerance. You must be tolerant to the market. Anything you take to the market is not everything that the market will tolerate. Then the next thing is suppliers, pricing terms, and inventory cost. Your suppliers. I heard somebody come to make an announcement about something as we are about to start. Whatever your supplier is selling to you will determine what you are selling back to your people that are buying from you. You can't do, there are 5 and 6. You can't separate one from the other. Deciding what to charge. The amount decided on must meet the following. It must be high enough to cover the cost of production. It must enable you to earn reasonable returns, and it must be low enough to encourage persons to keep buying or to tell others about your products. Don't forget, must be high. These three must be balanced. Don't let it be too low that it will not cover your cost of production. Now, 4 factors to focus on when setting price. knowledge of what your costs are. You must know the cost of production, very important. Knowledge of the price your competitors are selling at, what customers are willing to pay. You know, if you get to where it will reach, you go start opening tap water and we start drinking from tap water. When I was young, they used to just put one big pot in the house. I don't know how many of us know that time. They will go and fetch water in the river. There is one big pot. They will put somebody in the morning, they will put a cover and put one big cup. As you are going, you carry cup, you drink. As you are coming, you carry cup. Every visitor too, when they come, it's the same water, it's the same cup. The following morning, somebody will clean the cup and put it again. The same cup all of us will use. But now, we are drinking treated water, we are drinking all these things. Know also that there is a level to which you can price your goods that customer will not react. But it must be high enough to cover all your costs. Principles of costing, pricing strategies. There's cost plus pricing. You look at the cost, then you put margin. There's prestige pricing, just like I told you about the people that will go and build a lounge and now put people inside it. There's demand-oriented pricing, because the demand, forces of demand and supply. This is what has affected our naira now. Government say let us float it. Then demand and supply determine it. Now you can see what demand and supply are determining. So sometimes there's a need for us to put some checks in place. That's why sometimes it's good to have an organization like this, so that there won't be a free fall in the market. Other strategy, pricing to the market, discount pricing, penetration pricing, target market pricing. Now, break-even points. Calculating the break-even point can help entrepreneurs to decide if the price of an item. Before I talk about this break-even point, break-even point is the point where you are not making a profit or a loss. You have looked at the total cost, and after you sell it, you put all your expenses, you put everything. The total money you invested in that product and the total money you made from that product is the same. So total inflow minus total outflow is zero. That is break-even point. Now, for every business, we want to be sure that we cover all our costs. But calculating break-even point can help us determine if the price of an item should be increased or decreased. If the break-even point, that break-even point is what we determine. Because when we are operating below break-even point, then we need to increase our price. Expenses should be modified. It's not everything that we go and buy increasing price. We may also modify our expenses. And it also tells us whether we can succeed in that line of business, or should quickly go and do for a new line of business. Now we come to basic balance sheet and income statement. All these things we are saying, they are going into each other. Started from the bookkeeping, went on to costing, went on to pricing. Now, I explained earlier that everything owned by your business are your assets, and everything your business is owing other people are your liabilities. So, when, for instance, CBN says they are taking over a bank, they say we take over both the assets and liabilities. And when men marry women, they also take over both their assets and liabilities. That's why men's money is our money, and women's money is women's money. Now, fixed assets are items that the company plans to use over a long period of time to help them to generate income. Example, land, building. If you have land, if you have put a factory building on it, that's your fixed asset. If you have bought a machinery, water treating plant, that's a fixed asset, because you plan to use it for more than a year. Your truck, delivery truck, that's a fixed asset. So these are examples of fixed asset. It is owned by the company, and it's the company's assets, and it is a fixed asset. Then we also have current assets. Current assets are assets that are expected to be converted to cash or used within a year. Example, the cash in hand, the cash in bank. accounts receivable, people that are owing you money. Stock inventory, you hope that you'll be able to sell it so that you use the money to buy raw material and produce again. And other liquid assets. Liquid assets are like investments. The current asset account is important because it demonstrates the company's short-term liquidity and ability to pay its short-term obligations. So it's your current assets that determine your liquidity. Is this company a going concern? Can it pay everything it's owing to its suppliers? On the other side of the balance sheet, we have the liabilities. Liabilities represent everything that your company is owing other people. And there are three categories. There are the current liabilities. There are the company's short-term financial obligations. Bills that are due within 1 year or within the normal operating cycle. Current liabilities are typically settled using current assets. Examples of current liabilities are accounts payable, staff salaries, taxes, accrued expenses like electricity bill, DSTV bill. Those are accrued expenses. Short-term notes, income taxes, interest payable on loan, accrued interest, utilities like water bill, NEPA bill, rent, and other short-term debts. All these are liabilities. While non-current liabilities are debts that you owe for over a period of 12 months. For instance, if BOI decides to give you a loan and they say you can pay back in 5 years, that's a long-term liability. If an investor invests in your business and says, this money, just trade with it, after 5 years, come and give me an account, that's the long-term liability. Then there's the third category, shareholders' funds. Shareholders' funds in the company balance sheet is the excess of assets over the liabilities. Every company that is still a going concern, your assets must be more than your liabilities. What you have must be more than what you are owing people. If what you are owing people is more than what you have, the company has gone under. You say the company has going concern problem. The company, all those companies that Amcon has taken over, that is what happened to many of them. All those banks, or some of those banks that CBN has taken over, that is what happened to them. Their assets are less than their liabilities. So we expect that every company's assets must be more than the liabilities. So the difference between the assets and liabilities is now what is called shareholders' funds. And shareholders' funds can come in terms of share capital, the money you use to start the business. It can come in form of deposit for share. You want to increase your share in future because the company is making money, you deposit some money. It can also come in form of retained earnings. Your company made a profit of 10 million last year. You decide that this 10 million, don't let me work everything. Let me invest everything back into the business. That is retained earnings, and it is part of the shareholders' fund. So here I have a template of a balance sheet. XYZ Integrated Services Limited, balance sheet as at 31st December 2023. And we see everything here. The fixed assets, the current assets, the examples are given, the total assets, now the total of both the fixed assets and current assets. Then we now see the liabilities, creditors, we see great creditors, then we see the net assets. And from this, we see that the total net assets, that's total asset minus total liability, came to 14.9 million. Then we now write it on that, represented by share capital, deposit for share, and retained earnings. All of them must balance. That's why you see that the total net asset is 14.9, shareholders' funds is 14.9. So when they prepare your account for you, whether you are preparing it yourself, you are outsourcing it, or you have an accountant, when you see your balance sheet gives a snapshot of your business at every point in time. If you quickly go down to this represented by, it shows you the value of your business as at that particular day. So if your represented by is in credit, that means your business no get value again. It's just living on past glory. I pray that no business here will live on past glory. It's very key that we understand all these things. So This is the template for a balance sheet. Now, the kind of business we are doing here is manufacturing, because even though we are producing water, but the kind of accounting accountants will provide for you is different from that of the person that is trading. For the person that is trading is just going to buy and sell. For the one that is a consultant like myself, he will render service, they will pay him, and he will pay his staff salaries. But for somebody who is producing a good, then you will have to prepare a manufacturing account before you go into your profit or loss account. And what we have here is a template of a manufacturing account. So the items that go into your manufacturing account include the cost of your raw materials. The cost of raw materials is determined by looking at the opening stock of raw materials. What raw materials did I have at the beginning of the year? Plus purchases, the ones I bought during the year, minus closing stock. What is the balance at the end of the year? Whatever you get is your cost of raw materials that you have consumed. You do the same thing for work in progress, because there are some things you start for water business. I'm not sure that is very popular, but for other manufacturing and production, it's popular. You start something, maybe somebody that is producing a table. He has bought wood, he has started slicing the wood, he has cut it, but he did not finish making the table. That is work in progress. I don't know whether you have work in progress in your own business. Because once you start water, you must finish water. So there's no work in progress. Apart from the one they have not packed together. You know, when they finish producing, then they will count it, the number that will enter your bag. So the only thing that will constitute work in progress in your business is the one they have not packed together. But then, even that, the cost of it, you see what was the stock at the beginning of the year, what is the quantity that came from the ones that were manufactured, and how many were we able to package. So that is for the work in progress. And when we do that, we now get the total cost of goods we have produced. That is the total cost of goods. Now, there are some components here. Under raw materials consumed, we must add the direct labor and factory wages and production. When you get these slides, you will see the things there that we need to add before we get the raw materials cost. The cost of each item in material is not the only thing we are looking at. We are also looking at the direct labor, we are looking at factory wages, we are looking at some other direct expenses, things that deal that money you pay directly to make sure that that production is complete. And all of them together are called prime cost. Then you look at the factory overhead, this is like the factory rent. Factory rent is part of your production. Without a factory, you cannot produce. So the factory rent is part of your production. What you just do is to find a way of apportioning it, so that if, for instance, you are using this hall and there's manager's office, there is one that we are using to do production. We will apportion maybe by measurement. Now, okay, my manager is using 10 square meter, factory is using 15 square meter. So whatever money we are paying, if we use 15 over 25 times the cost for the factory. Why 10 over 25 will be the one for the cost for manager's office. So the one for manager's office and not marketer's office, that one can go under expenses. But the one for the factory is definitely part of the production cost. Then after that, we go to the profit or loss account. This is the template also. Here you look at your revenue and say, you can call it revenue, you can call it sales, you can call it turnover. It's the same thing. The three of them is the same thing. Depending on the kind of business you are doing. Sales, revenue, turnover, it's the same thing. Then after that, we look at return inward. There are some that when you sell them, they return them. Maybe they have leakages or whatever. So those ones, you must remove the cost from your sales because you are unable to sell those ones. Don't forget also that when I was talking about the methods of accounting, I said that there's accrual and cash basis, and we recommended accrual basis. So these sales includes both your credit sales, the one they sold on credit and the one they sold on cash. Everything must come here together. Less cost of sales. Now we are talking about finished goods. You know, before we were looking at raw materials, we're looking at work in progress, but the cost of sales here is looking at the opening stock of finished goods. That's the one we are packaged in the bag. The cost of production and other things. Maybe the people that are working in that place where they are packaging is their own labor. We add it to it to now get the total cost of sales. So by the time we remove this total cost of sales, and we remove transfer pricing also, that's the cost of the production that we derive from the manufacturing account. We will now get whatever is our gross profit. And it is from this gross profit now that we will now start removing other expenses like selling expenses, because selling expenses does not have anything to do directly with the production. So it's an expense, it's not a direct cost, it's not a factory expense. Marketing expenses, advertisement, office rent, depreciation of office table, manager salary, and people that don't have anything to do with the factory, and other office expenses. So by the time you deduct all of them, then you come down to your profit before tax. You make a provision for tax, you have profit after tax, and you have your retained profit for the year, which you can now determine whether you want to use it to go on holiday to Canada, or you want to turn it over to your business again. Because of our time, I won't go into class activity now. We'll just take all the questions at the end of the class. Now, we have looked at the essentials of bookkeeping. We have looked at costing, principles of costing. We have also looked at balance sheets. So at least we have an idea now. When we see balance sheet, we know what the balance sheet is. When we see profit and loss account, we know what it is. The profit or loss account is the one that determines whether your company or your business is making a profit, you are running it at a profit or at a loss. While the balance sheet is a snapshot of everything that you have put in your business and everything that has gone out of your business. So you just transfer whatever is the net profit, the retained profit from that place, and you go and join it to your shareholders' fund. Now, we want to focus more on profitability. In accounting and in business finance, even if you go to the bank and banks want to give you a loan, they want to be sure that whoever they want to finance is profitable, that there is profit in the business you are doing. And these are the indicators that we use to determine profitability. We use ratios, we use profitability, we use liquidity, we use financial risk, we use financial ratios. For the purpose of this class, we will focus on profitability. That's the easiest way you can know whether your your business is viable or your business is not viable. Now we look at aspects of financial performance. Profitability is very important aspect of business performance. It is not the only aspect of financial performance that should be monitored. The main aspects are profitability, liquidity, and financial risk. I've said I will focus on profitability alone. Now, what are we using it for? We use it for comparison over a period of years. What was my profit last year? What was my profit 2 years ago? What is the profit of my competitor? That's comparing you with companies of similar period. I'm doing this business. Mr. B is doing the same business. I'm making 1 million naira per month profit. Mr. B is making 1.5 million per month profit. What is the difference? Don't forget, there's a difference between turnover and profit. You can be making 100 million turnover and your profit is just 1 million. While Mr. B can be making 50 million turnover and his profit is 2 million. The difference is that somebody is more efficient than the other person. He's managing his own resources more efficiently. So part of the reasons why we are here is to encourage us to be more efficient in the management of our resources. Now, profitability depends on sales revenue and cost. That's what I just finished explaining actually. It depends on sales revenue and cost. And if your revenue is high and your cost is high, your profit will be low. If your revenue is high and your cost is low, you will make good profit. Your revenue can also be low and your cost is low and you will make good profit. And I have some examples here, but I don't think we should go into them because of time. Now, there are some things we can use to check our profitability. One of them is the sales growth. If you look at the growth of our sales, we can use it to check, is our profitability, is it improving? Now, there are two things that can determine our sales growth. Number one, you can see where my cursor is. Two things that determine our sales growth. There is the sales price and there is the sales volume. You can be doing the same number of products, just increase the price and your sales will go up. Just like when we were buying petrol for 195 per litre, and suddenly they are selling it at 670 per litre. You will enter filling station, you will fill your tank 50 litres, you will pay 10,000 naira. But now you enter, you pay the same 10,000 naira, maybe you go with 15 litres because the price has gone up. So the people selling fuel cannot say they are making profit. They are making more money, but they are not making as much sales as they were making. So this is another way of analyzing profitability. Do we just want to sell water because we want to sell water, or we want to sell so that we make money that is sustainable? So it can be based either because of sales price or sales volume. But our own focus should be on increasing volume rather than increasing the price. But remember that the price must cover the cost. That one is the number one thing. These are examples. I think we should just leave it like that and go to questions. If you have questions first, you have all the other.